So earlier on in the trading day, in the early session, you can expect premium to explode very early and then continue that explosion throughout the day, as opposed to a narrow fly, which sometimes you have to wait until later in the day. So the narrow fly, even though it's less costly, has less opportunity to profit. So you might want to use that in a much less volatile environment. So you might want to create a Batman that's maybe 20 wide on either side and maybe just go to that 1-to-9 risk to reward ratio and get them really close together and hope that you're going to get a good price. And then play that. Like today has been a really anemic day. I called it lukewarm, or is that what I called it? Lackluster, I think was the term I called it. And then there was somebody in the group that asked, well, how do we put some math, or how do we parse that? How do we determine what lackluster is? Is there some sort of systematic way that we can re-engineer lackluster? No. And, I'm not expecting everybody to look at my trades and say, oh, we must do what Ernie does because he knows everything. Because I don't. I don't know squat. I'm out there just like you trying to put on things that I think are appropriate for the condition. I'm also taking into consideration the market sentiment, the Federal Reserve, and what is their disposition? Are they going to be more accommodative or less accommodative? Are they going to be restrictive and tightening up their monetary policy? Or are they going to switch to a different mood? And that's usually reflected in the trend that you see in the market. And so all of that's going to play into the volatility and the cost of the trade and what I can expect for overall range of movement that day. Because if I expect much larger range of movement, then I'm willing to take way more risk or take a scaled down risk with much wider flies and push them further out with the potential of making better use of my capital. Other things that I would look at are things like overnight action in the Globex market. First, we have the Asian market and the European market are opening throughout the day. And I can look at those by looking at the futures market. And that will tell me a lot about what's potentially going to happen as the market opens. Not always, because between the European Open and the US market open, there's this big road bump called economic reports that usually come out between 8 o'clock and 9 o'clock in the morning that can have a substantial effect on either continuing whatever trend has been developed or reversing the trend that's been developed or squashing the trend that has been developed overnight. So that's another factor. You want to know what the overnight market's doing, what the bigger trend is doing, and then what the impact of an economic report might have on the market as the market opens. Wow, there's so many things that you have to consider. But what it really comes down to is how wide and how far out of the money do I want to put my fly? That's the ultimate choice. And all of those things that I talked about will directly influence how wide the fly is and how far out of the money that I want to put it. Now, the size can be calculated into that. So when I say calculated, it's all up here, right? I just make a mental estimation, a swag, a scientific wild ass guess. That's what a swag is. That doesn't mean that it's just a guess that I pull out of my ass. No, it is something that is born out of experience and also some math that I've maybe previously done or studies that I've done and understanding of how the market works. And so I have a general idea of what will work or what won't work and what has a better chance of working. So if I think there's going to be a super volatile market, I get amped up because I want to put on something super wide and way out of the money because I can use a small amount of money to potentially make huge profits. As a matter of fact, those have been my absolute best trades. One of the best trades I've ever had was a NASDAQ trade I made recently. It cost me $200 to get in. I made it 50 wide. It got somewhat into the market and I made like close to $3,000 off of a $200 bet. That is insane, right? And I put it out there, even though the expected move said something like, oh, the market's only going to move 30, 40 points, something ridiculous like that, and ended up moving 100 points. Right? That's why you cannot pay attention to the expected move. The expected move is really based on statistical averages and standard deviation, and it is also based on what the current market is priced in, but that doesn't tell you what could potentially happen because there are so many other things that can affect that potential that the expected move simply does not cover. How often do you see price come right in at the expected move? It does occasionally. But quite frankly, rarely does it hit the expected move. And particularly in the markets that we've seen lately, it's either way above it or way below it, usually way above it. So the expected move is not going to be your friend here.